Hey guys, this is Mark Shawson, the Pattern Trader. For the past 3 or 4 months, the most talked about topic on every media channel, every pundit, every analyst is will or won't the US go into a recession? And if we go into a recession, is it going to be a hard landing or a soft landing? And are we going to go into a recession in 2023 or are we going to a recession in 2024? In a moment, I'll discuss what a recession is. But before I do that, I just want to read something that I picked up from a bevy of economists back in about a month and a half ago. It says, economists see an overwhelming chance that the U.S. economy will sink into a recession for the rest of the year as a result of the Federal Reserve's massive rate hikes. The probability of a downturn in 2023 climbed to 70% in December, according to the latest Bloomberg monthly survey of economists, up from 65% in November. The poll conducted between December 12th and December 16th surveyed 38 economists. So all of these geniuses surmised that the U.S. was going to go into a recession by virtue of the tightening by the Federal Reserve. And guess what happened the following month? The stock market went up the most it has in 20 years. The NASDAQ was up 15% in January. That is the biggest climb since 2001. And stocks and bonds combined turned in the best January since 1975. So this basically goes to show that you cannot trade the markets based on fundamental information. By the time you see the news, by the time you read something, the market has already anticipated and moved ahead of that. A recession is generally defined as 2 consecutive quarters of contracting GDP. And basically, a recession is a contraction. Now, there are many types of recessions or even market crashes. There was a huge market crash in 2000 when all the dot-com stocks that fascinated investors all crashed. And then for another reason, in 2008, we had a huge plunge and a global worldwide crisis bordering on a depression as a result of over-speculation in the housing market. So the next recession, should it come, I would imagine would be of a lesser consequence than those recessions, but nonetheless, I expect it to be very punishing. Now, a recession is where people lose their jobs, businesses go out of business, and makes life very difficult. What the Federal Reserve is trying to do is heighten the unemployment. So right now, we've got record low employment, which is putting pressure on prices and demand and hiking inflation, which is exactly counter to what the Federal Reserve is trying to do. So in order to achieve its mandates, the Federal Reserve is actually trying to put people out of their jobs and people out of their businesses. And there is a lot of suffering when we go through these contractions, and especially on asset prices. So we have already been anticipating this global slowdown and this contraction and tightening by the Federal Reserve that started in January last year, 13 months ago. And we've seen many stocks plunge 60, 70, 80%. Stocks like DocuSign are down 80% from their highs. Even Netflix plunged 70% before recovering. Tesla is down 70% from its all-time highs before it briefly recovered this month. Even though we've had a huge recovery at Meta, we are still down 50% from the all-time highs. So you can see how these contractions can really hurt investors. So you need to know what to do and how to prepare. But don't worry, that's what we do at the Pattern Trader. At the Pattern Trader, I inform our members how to trade markets and read markets based only on the price. So I'm not looking what economists are saying. I'm not trying to read company balance sheets to see how much cash flow they have or what their projected earnings are. To me, price is a discounting mechanism. Price is ahead of the news. And what do I mean by that? So in the deepest, darkest fears last year in October, when the Federal Reserve began its tightening campaign and the fears of recession were heightened, we had a global energy crisis, we had a war in Ukraine, the markets plunged. But in October, they made a new low, and then by the end of the week, it closed on the high. This is what I call a key reversal. And in the deepest, darkest depths of fear, the market bottomed in October. And we are now 20% higher despite all of the fears of the Fed's tightening and all of the other crises. So the markets are actually ahead of events. They're ahead of the news. They're anticipatory, and you cannot trade them based on current circumstances. If we could, I'd just go downstairs and buy a Wall Street Journal, and we would all be rich that way. But the markets are counterintuitive. They are discounting. They are based on perception. They're based on psychology, and they are based on sentiment. And what I mean by sentiment, about a month and a half ago, everybody, including all these genius economies, were very bearish, and almost every pundit that I was watching on the financial news stations was predicting that the first half of 2023 was going to be very tough, and then you would likely have a rally in the back half. And guess what happened? The exact opposite happened. Like I said, we've had one of the biggest rallies on record in January. NASDAQ stocks have shot up over 15% in 1 month. Everybody is lined up on one side, and sentiment is so lined up on one side. You get a chance of being offsides, where the market catches you offsides. And that's exactly what we had. Everybody was so bearish, and started January, because everybody was so one-sided, the market caught everybody offsides. But I was already alerting our members to the possibility of a huge rally. I wrote letters January 7th, January 15th, where I said, be open to all possibilities, meaning the market was so bearish, the sentiment was so bearish, but I was seeing structures in the market, price structures, that pointed that the market was actually going to take off. And so our members made a hell of a lot of money betting on the long side of Meta, betting on the long side of Microsoft, betting on the long side of Workday. And now we've booked all of those profits, because I anticipate that the markets have come very far, very fast. They've gotten over their skis. And now it's yet to be seen if we put in a significant market top. I'm starting to get the feeling that we have, and that the anticipation of a recession will come to bear down the road, and we will be prepared. So now there's all types of ways that you can prepare yourself for recession. It sounds very scary. Asset prices are likely to plunge, but guess what? You can take advantage of that. Now, most stock market investors are buy and hold. They basically buy it, close their eyes, and hope 5-10 years from now that they'll wake up and their portfolios will be greater. But this is a bit of a canard, because what we've seen in a buy and hold investing is that you can be holding a stock for many years and still be underwater. So Disney, for instance, ticker symbol DIS, was a darling institutional portfolio stock for many years. Now, Disney in 2023 is trading at the same price it was in 2014. So think about that. You would have held a stock for 8-9 years, and you're exactly where you started. Amazon is much lower than it was 4 years ago. Facebook, Meta, is down much more than it was 3 years ago. Netflix is down more than it was 3 years ago. So what we try and do at the Pattern Trader is give our members a prism, a paradigm with which to view the markets through price structure, patterns, price action, and trends. And then it's all about risk and reward. So everything else is just conversation. The markets and trading is all about risk and reward. And what we try and teach our members is how to identify small pockets in the market where you can take a very small risk for a sizable upside. Sometimes I've taken a position in a stock and put my stop loss $2 away and made $20 on that stock. So that's a 10-to-1 risk versus reward. So this is what we are constantly doing at the Pattern Trader. If you would like to learn more how to get ahead of events and take advantage of a market decline, whether it be shorting an individual stock, and if you're not comfortable doing that, there's what we call an inverse ETFs. ETFs that actually benefit when the market goes down. So this is what we discuss. This is what we alert our members to. And if you would like more information, if you would like more tutorials, we do webinars, constantly free live events. If you'd like to sign up for those, then please click the link below, like this video, and subscribe, and we will be alerting you to various options down the road. With that said, I want to wish you a healthy and prosperous trading day, and I will see you next time.